So today we're going to finish up the accretion dilution analysis, the mini merger model, and just to kind of recap what we've been doing in terms of the mini merger model. In this model and in any situation that involves a transaction, I always think about modeling in three major steps, right? One is figuring out the purchase price calculation. And in this example, which I'm going to pull up now, in this example, whoops, the purchase price was given. So if it's not given, you have to go through your valuation analysis, which you learned in the first half of the program. If it's given, we'll calculate it this way, and we've done a lot of practice with that over the past week and last week. And once you have the purchase price, you want to figure out the uses of cash, as you know. And the uses of cash is really indicative of how much you need to put up to pay for the company and some other things, such as the need to retire the target net's debt. We spoke about that. And the potential to pay down transaction fees, legal fees, lawyer fees, due diligence fees. All of those funds are funded through a combination of debt or equity, or maybe even some cash if the company has cash on their balance sheet. And we've talked all about last week, and now you've learned how to sometimes infer whether equity will be used or debt. Namely, if it's a stock swap, you would use equity. A lot of times, it would be an estimation. And in this case, I had it driven by some percentage, some assumed percentage that's pretty random, but I have the debt percentage driven off of the equity percentage such that we can run an analysis, a variable analysis that's driven by the equity percentage. So if we have the equity 0%, the debt would obviously calculate as 100%. If we have the equity to be 100%, then the debt would kind of react as accordingly, okay? And we need that because we want to run a variable data table that's driven off of one variable or two variables only. And I want that variable within the sources to be equity. Okay? So once we have the sources and uses, right, in any merger, we want to go through the pro forma analysis. And just the high level, just to recap the accretion dilution analysis, is thinking about what this does to the target and acquire financials. And in a merger, you're basically adding together, line by line, acquire plus target, revenue all the way down to net income, except for line items dealing with target debt and target equity. So namely, no target interest, assuming you're paying down the target debt, and no target shares. And then you make 4 significant transaction adjustments. 1 to synergies or post-merger cost savings. 1 to the incremental allocation of purchase price over book value to intangible assets, that's amortizable. 1 to new interest if you're raising debt to fund the acquisition, and 1 to new shares if you're raising equity to fund the acquisition. So we lay all that out, and that creates a new E.P.S. that we compare to the old E.P.S. So we looked at how that was done by using simple cases. Now let's look at how that's done in the model. So everyone should have this so far, where we laid out the considerations, we laid out the purchase price per share, and we multiplied the purchase price per share by the number of shares to get the implied purchase price. So we're going to be paying $131 million for the target company. We talked about identifying what their target net debt is that will be assumed, and the transaction fees. So they have to put up $131,650,000. We assume for now, let's assume half-half equity debt. And the reason why I did that is because I want to analyze at the end of this, what difference would it make? If it's 50% equity, 50% debt, 100% equity, and 100% debt. And it's really important that you understand what's going to happen here and why. Now guys, just thinking about what we talked about 3 weeks ago, what do you remember when talking about raising equity versus raising debt? What impact does each have on E.P.S? Do you guys remember? Who could tell me? If you raise equity, what impact does that have on E.P.S? What do you guys think? I want to make sure you guys can hear me.
More riskier, it drives it down.
It drives it down. What about in compared to debt? Thank you. What about in compared to debt? What happens if you raise debt?
Well, it's less riskier than equity, so therefore it depends on the interest rate the higher the interest rate, the more impact it would have on shareholder value.
And which should have a greater impact to EPS, equity or debt? A greater, so you're saying both have a negative impact. Which has a greater negative impact? Emmanuel suggests equity. Right? We talked about equity more than likely would have a greater impact to EPS than interest, unless maybe interest, assuming the interest rate is reasonable, right? Interest rate 4, 5, 6. Why is that? Why does equity have a greater impact? We kind of had this, conversation in class last week. Why would equity, what kind of comes with that? So you're basically saying there's risk. Yeah, of course. There's, you have risk associated with the equity. So the investor is kind of pricing that risk into the model. The investor is saying, well, if I can get 4% of return on debt, I better get more on equity, because equity, I might not get my money back, or at least there's more of a chance that I won't get my money back, because there's a preference in paying back lenders over equity holders. So because of that, the investor is expecting more of a return. If the investor is expecting more of a return, as the company, you have to give out more. And so it's going to weigh heavier on your costs. Your EPS will go down for raising equity. So let's look at what impact that has here. Keep that in mind when we analyze this. Now, when we moved forward with running through the assumptions here, we started to lay out the acquisition multiples. And before doing that, we had to lay out all these target statistics first before building those multiples. So now we can do it. So now we looked at the purchase price and the enterprise value. Now we can look at what price is the company paying for the target company on an equity value and enterprise value basis. So the enterprise value per sales is going to be the enterprise value, 131,550, divided by the target company sales. And they're going to do it with the earliest date possible, just as close to acquisition as possible. We're going to talk about a lot of benefits of having a full-scale model, and one of the bigger benefits of having a full-scale model as opposed to a mini analysis is you can be a little bit more accurate with timing, you can be more accurate with the details. Right here, we only have 3 years. Let's just take the earliest year. We'll still get a good understanding as to what they're paying, okay? Then we're going to look at the enterprise value divided by EBITDA. And enterprise value divided by EBIT. Okay? You guys getting that? With purchase price, the purchase price is the equity value. Remember the difference between equity values and enterprise values, right? Equity values you can only compare, or equity values is after interest, after lenders have been paid. So you want to compare them with underlying metrics that are after interest. So that's why we have equity value. Purchase price here is effectively an equity value to net income. Enterprise value is before lenders have been paid, before debt, or before interest. That's why we compare enterprise value to EBIT, before interest, EBITDA, before interest, sales, way on the top, before interest. So purchase price is divided by net income. Okay? So that's purchase price or market value divided by net income. And then we have price to EPS or PE. This is our standard PE. When you look at PE, it's the price per share, not the overall price, the price per share divided by earnings per share. Again, acquisition multiple. So when I look at the price, we're analyzing the target. We're analyzing the price paid for the company. Price paid per share at the premium. That's what we're analyzing. How much do they pay for the company? Per share divided by the earnings per share. Now, the fact that these numbers match or are the same is no coincidence. Right? This is basically the same metric. One is on a per share basis. One is on more of an absolute basis. So if you take the purchase price and divide it by the shares, and you take the denominator, the net income, and divide it by the shares, you basically get price to EPS. And because shares divided by shares is 1, this is always going to be the same number. If anybody wants more of an explanation of that, send me a little text here and I'll open it up in OneNote and show you the calculation. Okay, but purchase price to net income is price to EPS. Okay, these are our assumptions that's going to drive the transaction analysis. And we're going to talk about this, analyze this, once the analysis is done. Okay? So, we have the acquirer. We have the target. In this box, we're going to go through the whole consolidation analysis that I kind of just overviewed a few minutes ago. We literally add together, line by line, revenue all the way down to net income, except line items dealing with debt and equity. So let's add together acquire plus target revenue. So I might go a little fast, but then I'm going to pause and let you guys catch up. Acquire plus target revenue. Acquire plus target expenses. Again, the perspective with this mini analysis is we just want a high-level indication of if this merger is financially viable before spending the time to build fully linked operating model, which we'll see next. That's the purpose of this high-level mini merger analysis. A lot of times in banking, you might ask, you might have a client and you don't really know what types of companies it's interested in. So you're going to start with casting a wide net and looking at maybe 20 companies. And then from just the size and the product mix, maybe narrow it down to 10. And they might all look the same and they might all be valuable candidates. So from there you want to see, is it now viable from a financial perspective? Your MD might say, I want to see analyses, acquisition analyses on these 10 candidates. Well, it's going to take a very long time to build 10 full-scale merger models. So you'd first want to build 10 of these to see which ones are even financially viable before digging deeper. So with that case, with that example, or with that idea in mind, we look at what are just the high-level metrics we need, just the high level, to be able to run that analysis. And, we really just need to get to EBITDA, as we've proven in the cases we've done in the past. Okay? Acquire plus target. Expenses. Okay? Now we have synergies. Notice here the synergies is 3% of total operating expenses. So I'm going to take this 3%, I'm going to anchor it and multiply it by total expenses. Okay? And I'm going to make this a negative because it's really going to offset the expenses. Right? Where the expenses are listed as a positive, every expense on this income statement is going to be listed as a positive. The synergies is going to be a negative to illustrate it's going to actually increase EBIT as opposed to reducing EBIT. And so the total expenses is 9,000 and you reduce it by 270. Right? So these are the total expenses. And then you can get your EBITDA by subtracting. So I'm going to pause for a second. I want to make sure everybody has everything up above and everybody has the 18,330 EBITDA. Okay. DNA for now, acquire plus target DNA. Okay. We now have our next adjustment, which is the additional amortization from the identifiable intangible assets. We spoke about purchase price allocation, and the idea of purchase price allocation is if you've paid a premium above the target company's book value, that premium usually, or used to be, lumped in as goodwill. Lumped in as goodwill, can't touch it, can't amortize it. So now you can really, that premium, that big block, can now be, you can dig in and allocate some of that gap into things that might be more beneficial from a tax perspective, like intangible assets. So you can say, well, the reason why I paid more for the company than what it's stated as worth on its book value is because I believe there is an intangible value, the brand, that really wasn't previously properly allocated. So say, okay, well, what's the value of that? How much can you allocate to that? And you can amortize that. So for now, as a first cut assumption, we're going to take 25% of the purchase price of a book value, and allocate that to this intangible asset that can be amortized over 15 years. So the purchase price, and this box is where we're going to calculate that, is 131250. The target book value, well, you just pull up from the shareholder's equity, and the price over book is going to be equal to the purchase price minus the book value, or 51 million. Okay, so the amortization on that is going to be 25% of that divided by 15 years, or 854.2 is the amortization on that allocation to intangible assets. Okay, that's an additional expense. We're going to link that in. We're going to assume that that is held flat, anchored, and so our total D&A is a sum of these two line items. It's the total D&A that's incurred. Okay? That's the total D&A. Then we have an EBIT. EBITDA minus D&A is the EBIT. Any questions on that? Okay. And the interest is going to be acquire only. Okay, don't do acquire plus target. Remember the rule. Acquire plus target everything except for line items dealing with target debt and target equity, so no target interest, no target shares. Okay, and then we have our third adjustment, which is new debt interest. This is the debt raised to fund the acquisition times the expected interest on that debt, which is given in the considerations, 5%. So we're assuming on all that debt raised, it will incur $3.291 million per year. We assume that it's held flat as a safe, simple assumption. Okay? Which means the total new interest is significantly higher. Okay? Everyone have that? Let me know if you need more time. I'm going to save this. Okay, so at this point, EBT, very simple, EBIT minus interest. This is what you guys should be getting. And we want to tax affect that. So that's going to be multiplied by the 35% tax rate that I'm going to anchor so I can copy to the right. Okay. And the net income, EBT minus taxes, is the net income. Okay, so everyone should be getting 7790 net income. Getting from this interest or EBIT with the interest down, this is pretty straightforward at this point. Okay. Shares outstanding, acquire only, not acquire plus target. The only two things that's acquire only is interest, okay, and shares outstanding. These are acquire only, right? Because of the idea that you're taking on everything about the target company except for items dealing with debt and equity. You pay down the debt, pay down the equity. So shares outstanding, acquire only. Okay. And then the fourth and final adjustment for the new shares raised is the equity raised to fund the acquisition, okay, divided by the price that the acquirer raises that equity at. So you have 658.3, okay, or a total new share count of 36583. So again, just make sure you have calculated that properly. You don't have any questions. And the EPS is the net income divided by those shares calculated. Okay? Everyone getting 213 in a minute? Let me know. And if you have it, we want to calculate the accretion dilution. What change, overall change, did this have over the original acquirer? Well, let's take a look, both on a percent basis, or on a cents basis and a percent basis. So 213, it was 212, so it moved by 1 penny. So it was actually dilutive, and then slowly became, I'll call that break even. And you can calculate the percentage too by taking that divided by the original. Right? Let me just fix the borders here. Okay? This is what you should be getting. If you don't get that, let me know. I'll take a second. So hopefully this should be relatively straightforward based on all the practice that we've had in the past, but it's important to analyze and interpret this, okay? So what's going on here? So they're a little bit dilutive, they're coming to break even. I want to look at how they're going to be trading now, how is this new entity going to trade, and then I really want to analyze the sensitivities, okay? So first off, I want to look at how is this new entity going to trade in the market, okay? So first of all, market value, right? What is this new entity going to be trading at? What stock price? How do we know the stock price that this new entity is going to be trading at? Does anybody have an idea? How it would be trading? What price? Do we come up with some formula for it? Do we make it up? What do you guys think? In reality, and I wanted this to turn into a little conversation about what happens to the acquired stock price post-acquisition, but really the short answer is the acquirer stock price, we're still the acquiring entity, so we would use the acquirer stock price. It might go down a little bit, but for now, we'll take the acquirer stock price, which is 100. Let's anchor that, and we'll multiply it by the new shares. The new adjusted shares. This is effectively the new market cap of the merged entity. Okay? So that's the implied equity value. And the next question is, well, what about the implied enterprise value? And for the implied enterprise value, there's one other item that we need that we didn't have before. It's how much debt does the acquirer have on its balance sheet? We didn't have that before. We had the target's debt, not the acquirer's. So let's say we had to go to the acquirer's model or the acquirer's annual report, and we noticed that they had $2,500 in debt. So the enterprise value, we need to get the equity value or the market cap, which we have. We need to get the debt of the acquiring business plus the new debt raised to fund the acquisition. Okay? That would give us total debt and total enterprise value. Okay? Make sure you guys are getting that. And with that enterprise value, we can calculate the underlying metrics. Okay? So we could take enterprise value and we can divide it by sales. We could take enterprise value divided by EBITDA. This is just straight making multiples, making metrics. Divided by EBIT. Okay? And with market value, just like you did above. So what I'm going to do is just, it would take a few minutes to get this and try to back into my numbers, try to match my numbers. Putting together multiples, you should know how to do at this point. And when you take the price to EPS, my question to you is, which price are we taking? What price are we looking at? What do you guys think? So we'll take the share price, 100, anchor that, divided by the new EPS, should match. It does. This is what we should get. Okay? I don't know. Do you guys need more time with this? Do you have this? You okay with this? Okay. Now, let's analyze some of this output. We have a sensitivity table here that I want to help us figure out what the accretion dilution would be under two certain varying scenarios. And the scenarios I want to vary are the most variable of the variable scenarios, which is what would happen if our premium changes and what would happen if our debt equity ratio changes. Because the reality is when you're negotiating a deal, there are a lot of unknowns, and in the full scale model we'll help to narrow down all the possible unknowns into a few. But the two major ones in the beginning are always, how much of a premium will I be paying? In other words, how much premium do I have to pay to convince the shareholders to give me their shares? I want to pay as little as possible, but I want the deal to get done, right? And secondly, what's my debt equity sources? Number one, how much debt should I be paying? How much debt do I want to pay? How much equity should I be paying? How much equity do I want to pay? Well, let's look at what varying each has in terms of an impact on EPS, and then we'll take it from there. Okay, so in the beginning, first of all, the way a two-variable data table works is in the upper left corner of the table, I want a link in from the model that represents what I want the table to be populated with. So I want the table to be populated with, let's say, 2019 accretion dilution, for example. So I want this to be linked into here. We'll break even here, and let's see how that changes based on varying left to right the percent equity and up and down the percent premium. So here I want this to say, well, what happens if it's 0% equity? What happens if it's 50% equity? What happens if it's 100% equity? And here I want to see what happens if I only get to pay a 5% premium. 10, 15, 20, 25, 30. So for example, the way the table works is right now we're running a 50% equity, 25% premium case, meaning here, this 0% should be populated here, right? And let's say, for example, what if I run a 100% debt or 0% equity, 5% premium case? Well, if I run the model with 0% equity, 5% premium, the results of that model should be placed here, 0% equity, 5% premium, it looks like 3%. And so on, right? And if there wasn't this automated two-variable data table that I'm going to show you now, you'd have to kind of run every scenario and slowly populate the table where the two variables cross, right? But there is an automated way to do this. And the way to do that is, I'm going to put this back to 50% equity, 50% debt, although it doesn't really matter. This could be set anywhere for the table to run properly. Your model must be built properly for the table to be run properly. It'll overwrite these hard codes, so it doesn't matter. I need to highlight the whole table. Right, the table structure has to be such that in the upper left corner you have a link in from the model representing what you want the table to be populated with. To the right of that link, you need one series of adjusted variables, and underneath a second series of adjusted variables. Highlight everything, and you want to open up the data table by doing either Alt-DT, or everybody has different versions of Excel, but you can go to Data, What If Analysis, and then Data Table. Or you might have to go to, some people have, maybe if you have an Apple computer, you might have to have like a little picture of an Excel spreadsheet. Click that and go to Options, Data Table, or Options, What If Analysis. Either way, everyone, if you get to the right place, this table will pop up. And it's asking for two inputs. One, the row input cell, meaning it sees 0, 50, 100%. It sees the inputs along the row. Where does it have to go in the model to adjust that variable? Now, we just did it manually, and if we want to run the 0% case, we had to go up into the percent equity to adjust it. That's what it wants to know. Where does it have to go? Because when it runs this, it's going to run a macro that hardcode that pastes 0% here, pastes 50% here, and 100% here, and hardcodes the answer. Next, column input cell. Basically asking, it sees 5, 10, 15, 20, 25, 30. Where does it go in the model to vary that output? That's the percent premium. And if you've done everything right, if your model's built right, if you hit OK, this is what you'll get. Okay? Now, first question. I don't know why that's bold. I'm going to unbold everything. Is this what everybody's getting? If you're not getting it that way, either you've constructed the table wrong or your model isn't linking properly. So let me know if you're not getting that. Let's take a second. All right, let's analyze this. So what's going on here? Are these trends expected? Is this what you would expect? Does this look okay? What do you think? So we're break even if we raise 25% equity and we kind of said 50% debt, 50% equity. Who can analyze what's going on here? And the idea with these sensitivities is to say, okay, well, what if 25% isn't enough? Or what if 25% is too much of a premium? Do I care, right? What if the difference between 20% and 25% is insignificant? So I said, listen, I really want this deal. I'd better to offer 25% just to get it done because it's making a minimal impact. What about debt versus equity? What's going on? What takeaway can you see from this? How do you think through it?
The more equity percentage we use, the better the E.P.S gets.
So the more equity, the better. So now, more equity, the better. What about the more premium that we raise?
The opposite effect. So we want to pay less premium and more equity, possibly.
So we pay more premium, right? You pay more premium and it weighs heavier on your E.P.S. Does that make sense? Does it make sense that the more that you pay, the harder a hit it is to your E.P.S.? What do you think? Anybody? Anybody? If we pay more premium, it's a harder hit. What do you guys think about that?
Either you have to add more new shares or you have to pay more interest expense.
Okay. Yeah, you know, if your purchase price increases, right, effectively your sources are going to increase, right? Your debt increases, meaning your interest increases. Your equity increases, meaning the shares raised increases. So it definitely would impact it all around, right? So that makes sense. What about the equity? So the more equity you put in, 0% debt case is dilutive. We raise equity, it's becoming accretive. Does that make sense? What do you think about that? What do you think about that prospect, right? Raising equity, what do you think? When the equity increases, Beatrice mentions the number of shares increases.
The other side to that is that it's percentage of debt, so that as the equity percentage increases, the debt decreases, and the balancing between the interest expense and the increase in shares outweighs. So the E.P.S. Oh, sorry. Let me put it the other way. The number of shares, the effect of coming from number of shares, it outweighs the interest expense, and thus it's more risk, and again that leads to more earnings. It's just a balancing between the debt and the equity on the other side. Is that what you're trying to get?
If it's more risk, should it be a benefit to earnings, or should it be a heavier weight on the earnings? So what you guys were kind of suggesting, which is right, is when you're raising equity, you're issuing more shares. Does issuing more shares increase EPS or decrease?
Usually decreases.
Yeah, usually decrease, but the other side of this is the debt. So the effect that's coming from raising debt and the effect that's coming from raising equity.
So let me step back. Yeah, let me step back and rephrase what you guys are saying to figure out what questions we have now. So ideally what you're saying is raising equity should have a negative impact on EPS because you're raising shares. Actually, we talked about that last week, right? We talked about raising equity having a negative impact on shares. In this case, though, it's not doing that. It's actually increasing EPS. The question is why? Why is raising equity increasing EPS when we thought and concluded last time that it should be decreasing EPS? Actually, didn't we conclude that it should be decreasing EPS more than the debt raise? Why do we say that again? You guys remember? The risk. So why in this case is it increasing? And remember, Drew made a good point too about the balance. Think about, in this case, just look across the row. Right? Let's look at 30% premium, the most extreme, where raising debt is 15% dilutive. Raising equity is 100% accretive. We're talking about everything else is the same. We're buying the same company. The purchase price is the same. The only difference here is we're saying, well, we can raise debt to fund it, or we can raise equity. So what's causing the 15%, when raising debt, what's causing the 15% dilution? What do you think is causing the 15% dilution?
Interest
expense.
Exactly. Interest expense. You raise debt, you have the additional impact. You got a lot of other things attributing to the EPS loss, but I'm talking just the difference between debt and equity. You have added interest expense. What about equity? What's the impact of raising equity? You guys mentioned it. Shares.
New shares.
New shares.
Yes.
So if the debt impact is interest and the equity impact is shares, why is the equity impact increasing? And you want to think about the balance between debt and equity. What drives the interest calculated on the debt?
Is it because we're assuming the total adjusted shares stay the same once we make the purchase? Actually, take that back. Sorry.
Well, we're looking at it 1 year, though. So I see where you're
Yeah, we're looking at 1 year.
We're looking at 1 year. And same thing with interest. We're assuming that it's flat. That's one flaw with the mini merger model we're going to point out after the break. But Cortez mentioned interest rate. The interest rate is driving the interest expense. What's driving the equity raise? What's driving then the new shares?
to share price?
Share price. The market, share price. So for some reason, in this example, right, typically we've analyzed when doing the independent equity raise versus debt raise cases, we've analyzed that there's an impact, a negative impact on EPS when raising debt because of the interest rate. There's also, on the other hand, a negative impact of raising equity because of the shares given back, the shares given to the investors. And we talked about the balance between the two, and Drew, and you guys mentioned the balance between the two, Beatrice and Cortez. And the question is, we concluded when running these independent cases that raising equity should be more dilutive because of the risk associated with that. Right? But how does that translate into numbers? How did the fact that it was more dilutive impact EPS greater than raising debt? Do you see where I'm going? How did that happen? Where is that?
Paul,
Yes.
is it because we're looking at net income, right?
Mhm.
And because we're looking at net income, it's distribution to shareholders and from the investor's perspective. So if we're raising equity, it will mean that shareholders are getting more. But if we're raising debt, right, because debt holders will take interest away from the net income, so therefore shareholders are getting less, and hence there's a dilutive effect. I'm not sure. I'm just throwing it out there.
No, I like the way you're thinking about it. You're partially right. I mean, I don't follow what you mean about it as a percentage of net income.
Okay.
But in terms of thinking about it, in terms of thinking about it as the net income being raised, sorry, the equity impacting the investors' price of the shares versus the interest, I follow you with. But you opened up by saying based on net income, and then I didn't see how that kind of flowed through.
All right. Okay, cool. Let me think about it first.
I mean, think about what's going on here. So the debt raise based on interest is the impact here. Equity raise impact is the shares. Interest that's weighing down the EPS in the debt raise is based on the interest rate. The shares that's weighing down EPS is based on what? Just recapping. The shares is
The share price.
share price. And we concluded that the impact of the equity raise should be more negative. Why? Why was that the case? Impact of the shares more negative?
Higher risk.
Higher risk, theoretically, driven by what then? Driven by what?
EPS.
Say it
Driven
again?
by higher EPS.
By lower EPS, caused by what? So if there's higher risk, which is sort of subjective, how does that translate into lower EPS?
Because we have more shares but the same net income.
Yep. Okay, maybe, Alex, this is what you were trying to say, but why do we have more shares?
Because we have to raise equity in order to finance.
And what's the variable determining whether the number of shares raised makes it more dilutive than debt? See what I'm saying?
Yeah, I think we're very close, but that one connecting point we can't get.
What's the variable? That's right.
Current stock price.
Current stock price. The current stock price. Sounds very simple, but it's important about how to think about it. It's the current stock price is what's driving the notion that equity needs to be more dilutive than debt, which is set by the market. set by the investor. The investor has to step back and have the foresight to say, well, listen, I can invest in debt at 4% interest, but if you want equity from me, I have to raise the price or adjust the price to make it more dilutive to the company. Otherwise, it's not worth it to me. And investors might not know that. The investors have to say, listen, I got to get paid for my risk. That's got to be set in the price. This is where market dynamics might slip when looking at technical things. So what do I mean? I mean, if
we're assuming the same stock price, however, in reality, we may not get that, right? As a company issues more shares, the dilutive effect on the price will be lower than what it is, and is that why? But we didn't take that into account in the model.
Say that again, Dhruv.
In our model, in the sensitivity analysis, we kept the price same at $100.
Yep.
So I get that the market value determines and it's driving these factors, but however, that factor is stayed constant in our sensitivity analysis.
It stayed constant, but you want to look at that factor relative to the impact of raising debt. So for example, if I was an investor investing in this company and I invest in debt, I would get a 5% return. If I were investing in equity, how much of a return would I get? It's kind of more difficult to answer. But my point is this. In order for this to be reversed, because this is reversed, right? When I say reversed, I mean raising equity should be more dilutive than raising debt. It should be more dilutive to the company, meaning it's more of a benefit to me as an investor. Because if it's more dilutive to the company, that means the company is giving away more for raising equity. But no, not in this case. In this case, the company is raising equity and it's actually making money. It's actually becoming accretive. Why is that happening? Something that's upside down about our theory that raising equity is more dilutive than raising debt. What's upside down? Well, there's only two variables involved, interest rate or stock price. So based on those two variables, either the interest rate charged is so high, so exorbitantly high, that the impact of raising debt or the interest expense is greater than raising equity, or there's something wrong with the stock price. Now, we saw the interest rate is 5%. So it's not so high. So interest rate is set normal. Something's wrong with the stock price. What could be wrong with it?
When you issue more stocks, maybe the price decreases because...
Maybe it does, but let's assume that it doesn't. Let's assume that it is static and it's okay that it's static. If it's static, what's wrong with the stock price as it stands? What could be wrong? What do you think? So where we're at is we have this dynamic that, we know raising equity should be more dilutive than raising debt. It should be, in theory, because it's more risk. This goes back to our CAPM drawings and all this stuff. Here it's not. Question is why? What's driving E.P.S impact when raising debt? Interest expense driven by the interest rate. What's driving equity impact? The E.P.S impact on equity. The shares raised driven by the share price. So usually we have the share price set, or you would assume that the investor would set the share price to say, listen, this is going to be a better return for me. I'm going to get more for the company for investing in equity. I'm going to get more of a return because there's more risk. And to the company says, all right, well, I got to give away more. I got to give back more to the investor, meaning raising equity is going to be more dilutive to my E.P.S. because I'm giving out more. In this case, that's not happening. Actually, it's backwards. The company is getting more. Why is that? What's driving that? What's happening? For some reason, the company is raising equity when it should be more dilutive than debt, It's a benefit. And we have to analyze the stock price further. So let's look at it. So I want to look at the stock. How do I analyze a stock price in terms of value? There's a few ways to do it. One way is multiples, right? So let's look at the multiple. If I look at the multiple of the stock, let's say I look at the acquired stock price 100, and I divide it by the acquirer's earnings per share, 2. PE, let's look at the PE, 47.1. Okay, what does that mean? Does that give you a clue? Anybody have an idea as to what that means?
Investors are willing to pay
Stock price
47
is overpriced.
Exactly. It's high. It's exorbitantly high. The stock is overvalued. What does that mean if the stock is overvalued? Well, the stock is overvalued, the investor is paying a lot of money, which means what? The investor is starting at an investment basis that's much higher than maybe what the company should be valued at. So it's going to be much harder for the investor to get its money back, to get its return. It's starting at a higher base, right? If the company's stock price is low, you can make more money, assuming that the company is growing. What that also means is, from the company's perspective, if the stock price is super high, is really high, the company can meet its funding needs by raising a lot fewer shares than it has to. Right? So if the stock price, the company wants to raise $1 million, right? And the stock price is at $1. It's got to raise 1 million shares. That could be dilutive. If the company wants to raise $1 million and investors are willing to pay $1 million per share, some ridiculous price, you only have to raise 1 share. It's not going to be dilutive at all. If the price is overvalued, you can meet your funding needs by raising very few shares. So in this case, the company is meeting its funding needs by raising 600 shares at $100 a share. Now, what if the company was what if the company's stock price was priced at $10 a share? Then it'd have to raise 6,000 shares. That's super dilutive. So what's wrong is when the stock is overvalued, investors keep pouring money into the stock, then the companies can meet their funding needs by raising very few shares. It actually is accretive. The investors are putting more money in, creating this accretive effect. And this is why back in a lot of situations where companies are overvalued, bankers start to say, oh, the markets are great. This is a great time to raise stock. You can get a lot of value for your stock. Investors are giving you money, and you can raise fewer shares to meet your funding needs. And we see this happen time and time again. We see this happen, a great example that I talk about is, 1999, 2000. Right? This was a time when, the internet was booming, right? And there's a lot of these big acquisitions were happening. One example I always give is the AOL America Online acquisition of Time Warner, where America Online was this, at the time, hot tech company. And they paid for this company, Time Warner, that's been around for many, many years and had billions of dollars in storied assets. And this company, America Online, just did an all equity. They raised a lot of equity to buy this company. And they were super overvalued. And back then, when that happened, a lot of articles came out about CAPM because this transaction was accretive. America Online came out, they bought this big company that was much bigger than them. They raised a lot of equity and it was accretive for them. And CAPM says a transaction like this, raising all equity, should be dilutive. So all these Wall Street Journal articles came out about CAPM is wrong, it doesn't exist in this environment anymore, people are doing deals and it's accretive. And the argument against that I always believed and that people argued against that is, well, CAPM maybe wasn't showing itself appropriately in that case because CAPM assumes the investor is rational. Right? A rational investor would see that this is an overvalued situation. A rational investor would see that they should never invest equity in a business that's overvalued because they probably won't get their returns. There's a couple takeaways from this, right? So number one takeaway is, why did that happen? Why did investors, and there's a lot of back and forth and debate about that as well. What makes a rational investor? And back in 99 and 2000, technology was new. Before 99, 2000, believe it or not, in order to trade in stocks, you pretty much had to go through a broker. You had to pick up the phone, and your broker basically was a gateway saying, oh, I wouldn't do this, or I would do this. And in 99, 2000, E-Trade came out, Ameritrade came out, and if you were an aggressive, technology-oriented person, you'd put your credit card online. Back then, that wasn't done so often, and you can just make trades without having to go through a broker. And so back then, people would read a lot of hype about these companies, AOL, Time Warner, and they put money out of their pocket in. So there were maybe a lot more irrational investors out there. That argument existed. This is a good example how these models can show the damage that can be done. And America Online, Time Warner, obviously all these companies that came out and all these articles came out that said CAPM is wrong. It's an old model. Well, what happened years later was these companies, the values were reset, and there was kind of value destruction, right? I don't know if you know what happened with AOL Time Warner, but they ended up having to write down a lot of Time Warner's assets. They ended up splitting. It was just terrible. So there are a lot of interesting takeaways here about accretion, dilution, and the impact of equity. Equity is dilutive in relation to risk, and is dilutive only when the stock is appropriately valued. Very important. Another side takeaway is some people say you can invert the PE to get an appropriate estimation of the expected return on equity. So if the PE is 47.1 and you invert that, 1 divided by that, then the implied return could be 2%. Very, very low, because the investor is paying such a high price. So that explains why at 5% return, debt is a better investment than 2%. So what if the stock was appropriately valued? Okay, what if the stock was trading at a multiple, not 47.1, but at a multiple that was in line with what the investors expect? When I say in line with what the investors expect, I mean, maybe the S&P 500 trades on average 15 times earnings. So if the stock was priced to be at 15 times earnings, 15 times 2 is, let's say, $30. So if the investor in this example was shrewd and said, listen, I'm not going to pay $100, I'd pay $30, that to me is an appropriate price, I should expect to see a normal trend. A normal trend meaning as I shift from debt to equity, it should be more dilutive. And if you come down here, it is. Raising equity is more dilutive. That makes a lot more sense. This is a CAPM driven model where the investor is rational. So a lot of important takeaways about debt versus equity and the impact on accretion dilution.